Welcome back to the Modern Day Way podcast. Today we've got an awesome guest, Ryan Huff. He's a CPA, he's a dad, and he's just cool. So I'm really looking forward to having him on the podcast today and listening to him and learning from him. So Benjamin, I think you got a quick disclaimer for us.
Yeah, that's right. So just to help cover Ryan here and ourselves as well, the topics presented in the episode today are intended to serve as general information regarding the subjects of real estate and taxes. It's not intended to serve as legal, tax, or other financial advice related to your individual situation. Please consult with your own attorney, CPA, and or other advisor regarding your specific tax situation.
Awesome. All right.
Anything else you want to add, Ryan, before we get started?
No, that sums it up. That's pretty good.
Okay.
All right. So we're going into tax season right now. And so I know that a whole bunch of people got tax questions. I got my own tax questions. I got a meeting with Ryan later on about those. But let's focus on some of the general ones. Benjamin, what's a quick tax question you can think of to ask Ryan?
Yeah. Right off the bat, what are the most important tax implications to consider when purchasing real estate?
Well, probably the largest would be to keep good records of what you're doing. There are very technical issues when it comes to real estate. I think we'll talk about those a little later, but just to give a brief topic would be to understand that rental income is passive income. It's not active or considered non-passive. And so you got to understand how that is treated for tax purposes, whether you can take losses or how the income is treated. There's different types of income. There's passive income and then there's self-employment income, and they are taxed at different ways.
Awesome. You mentioned record keeping. What types of documents or numbers should people be paying attention to throughout the year to set themselves up for success when it comes time to file?
Probably just keeping track of all the expenses. Whenever you have real estate that you're renting out and you're reporting income, you want to squeeze every bit of legal deduction you can. So any amount of money that you're putting into it, you need to keep good records for, because why would you want to pay tax on income and not pick up all your deductions?
Yeah, I mean, why wouldn't you try to save all the money you can, ultimately?
Correct.
Right?
Yeah.
You get all these tax deductions. I think people look at them as like, oh, I'm saving money, I'm ripping off the IRS. No, you're not. You're following the law, right? You're allowed to take these deductions. You're allowed to write off these items. And ultimately, the IRS wants you to, too, because, it's the code and the law that they wrote.
So, Ryan, you mentioned rental income. What about as a homeowner? What benefits do you have there tax-wise?
So as a homeowner, just for your real estate that you own, the deductions are very limited. Whatever you put in for renovations, those are considered personal outlays and are not deductible in any way. But you can deduct real estate taxes and mortgage interest on Schedule A of your personal tax return, which is for itemized deductions. And if you have enough of those deductions, you get to take those instead of taking the standard deduction.
What is the standard deduction for 2023 that you would have to exceed in order to be able to start itemizing?
For individuals, it's around I think it's around 12,000, a little over 12,000. I don't know the exact number. And then for married filing joint, it's double that.
Okay, awesome.
So you can't write off the new countertops, is what you're saying?
Correct.
Okay. Roger that. I'm a little disappointed, but it's good to know, yeah, right? But if you're an investor and you put new countertops in that case, you can write them off.
Correct. Now, then you get into rules for depreciation and how do you, what type of property is it and how long can it be depreciated for? Can it be written off using an accelerated method or not? And so then you have to look at the type of property you are adding to your investment. And so if like countertops, for example, that's a fixed part of the structure. And so that would be written off over 27 and a half years. You don't get an accelerated write-off for that.
And if you do want to take an accelerated write-off, you can do what's called a cost segregation study. Am I right on that?
Yes. If you buy a property for like $1 million, you can, and you just pay $1 million. You don't know what that $1 million is, how it's allocated. You can pay for a study to be done or try to do it yourself, which I really don't recommend. Which what they do is they take that $1 million you paid and they allocate it to different systems of the building that can be depreciated faster than, like if it was commercial property, that's 39. You have to depreciate that over 39 years. And a cost seg study can pick out the 5 and 7 and 15-year property and subject to that to accelerated depreciation.
Okay, so you have to break up your property into its different functional areas and then depreciate those in an accelerated way,
Right,
individually,
and that's
instead
what
of the whole building
you're paying
as
a
one.
professional that's like what they do for a living.
Okay.
Sometimes they're engineers. Sometimes they're a mix of engineers and CPAs. So it depends on probably who you hire, but that's what they do, and so they're very good at breaking out the different types of property that make up that one number you paid.
1031 exchange. We hear this all the time, and I've had the opportunity a bunch of times to help clients through a 1031 exchange process. But I want to hear from you. How would you sum up what a 1031 exchange is?
A 1031 exchange is it's a like-kind exchange. It's under Code Section 1031, and it is a fantastic tool to defer gain when you sell a property. Let's say you have a rental property, and let's say it's just like maybe a multifamily rental property, and you decide you want to invest in a larger piece of property, maybe a larger apartment building or something, and you want to fund that, you're going to sell your smaller property to go into the bigger property. Well, if you had that property, and let's say you have a taxable gain of, say, $300,000, you have the opportunity to, instead of paying tax on that gain when you sell it, you can defer that gain and roll it into your acquiring property, and it decreases the basis of the property you're buying, and it kind of kicks the can down the road of when you're going to actually pay tax on the gain. So now if you go sell that new property later on down the road, it's going to be incorporated into that sale.
Gotcha.
That's awesome. So you can defer paying taxes through a 1031 exchange. You can also give real estate to your heirs at time of death without increasing the cost basis for tax purposes, right? Can you explain a little bit about how that works?
Sure. If you inherit property from a relative or parent or something like that, the basis of it gets stepped up at the time of death. So if it's, let's say you have a basis of $100,000 on $1 million house and you pass away, your heirs actually get the stepped up basis up to $1 million.
Okay.
Up to what the fair market value is at the time of death. And so essentially that means that they won't pay tax when they go to sell it.
Okay.
If they sell it for that same amount.
Okay. That's awesome. That's awesome.
So what about this term I heard, reverse 1031 exchange? Basically the same thing, but instead of waiting to sell and then buy, you first buy and then sell.
That gets really technical with those reverse like-kind exchanges. I definitely recommend reaching out to a professional who deals with that, because the rules are very complex, and you definitely need, even in a regular 1031 exchange, you need to use professionals, because if you don't do it right, it doesn't count, even though your intentions were all good. For example, I've had a client who, they went and sold their property, and then they go, okay, I sold my building, let's do this 1031 exchange.
Yeah.
And I had to tell him, it's too late. You didn't do it right. You can't sell the property and then do it. You actually have to work with a qualified intermediary before you do anything. And so whenever you go to sell a property, for example, in a 1031 exchange, you set it up with your qualified intermediary, you sell the property, the proceeds from that sale go into an escrow account where you don't have access to and you can't touch. Then you have 45 days to identify replacement property. And that's kind of like, it's not really informal, but you need to pick and document that you have found replacement property in 45 days. Now, you don't have to buy those in 45 days. You have 180 days to actually execute and to purchase replacement property. So the timeline, the rules are pretty complex. You need to document everything like crazy, and you need to use qualified professionals whenever you do these things. So it's good to know the rules before you even start. Otherwise, you could get into the situation like my example where, he was well-intentioned, but everything was done wrong and didn't count.
Yeah, I've had plenty of sellers do that as well.
Yeah, I had that happen last month when I was dual agent on a land deal, and we were 2 days before closing, and I'm not working too closely with the seller. I've got the buyer since it's an off-market deal, and the seller was kind of representing himself. And I go to talk to the seller. I'm like, okay, cool. So you're 1031ing this, right? So you have everything written out. You've been working with a 1031 exchange rep. We're good to go. He goes, I just thought we were going to 1031 exchange the day of closing. And I'm like, well, first off, this is why you hire somebody who's going to be able to handle the real estate transaction the proper way, right, and do all the right steps as to where you're paying our commission for one, right, and then we're going to be able to provide these, introductions. And so I introduced him to a 1031 exchange rep through the title company, and we had to push back closing a little bit because it does take a little bit of time, right, to get all those things in action. And we closed a week later. 1031 went through. He had those funds and was able to do the steps to get the 1031 taken care of the correct way that Ryan was talking about. But having those people lined up ahead of time before starting that transaction is crucial, or else you're going to be kind of caught in the rat race and get super worried about it not going through the right way.
Very much, yes.
So rental income. How is rental income taxed?
So rental income is considered passive income. And so like I was saying earlier, one of the most important things probably with real estate and rental income is to really understand what passive income means and how it's taxed. So there's different types of income. There's self-employment income. There's passive income. Everyone, they buy a property, and the whole idea is to create passive income, right? Passive income is really the general definition is you're not doing anything. It's kind of generating its own income without you really doing much, right? Mm-hmm. Well, there are drawbacks and benefits to that. The benefit to it is that it's not taxed at self-employment rates. And so if you have a bunch of rental income, then you're not subject to the higher self-employment tax rates. Now, the drawback is that it is subject, because all passive income is subject to something called the net investment income tax, which is just 3.8%, but it is an additional layer of tax. So all passive income is subject to the net investment income tax. The other problem is that if you have passive losses, you are generally not able to deduct those passive losses unless you have passive income from other sources. Now, there are some exceptions to that. For example, if your modified adjusted gross income is $100,000 or less, you can deduct up to $25,000 of passive losses against any other income. That's if you're W-2 income or interest income or other business income that's active, you can deduct it against that, but it's only up to $25,000. Once your income exceeds that amount, the $100,000, then that loss, you're unable to use it. It gets carried forward until you do generate passive income to offset it.
Is that household income or individual income?
Both.
Both? Okay. So, yeah. So $100,000 per house, right?
Correct.
Okay.
How many years can you carry forward a loss?
It's indefinite. It carries forward until it can be used up.
Awesome.
Now, the other thing about passive versus non-passive is whether or not you could be characterized as a real estate professional. A lot of people, they try to get to that because a lot of people, when they get these real estate, they buy property and they're renting it out, and it's generating maybe book losses, because you're depreciating the property. Maybe you renovated it, and so you're depreciating that. Maybe you buy a bunch of personal property, like equipment to use to, maintain the property, whatever it is, and you're putting all this money into it, and let's say it's generating losses. Well, like I said, those losses you're unable to take, right? So a lot of people, they turn to maybe trying to define themselves as a real estate professional, but that in and of itself has a whole bunch of set of rules that you really need to meet in order to meet that qualification. And even then, it's still a double-edged sword, because then you lose the fact that it's passive income and now it's self-employment income,
So if you qualify as a real estate professional, you take rental income and it becomes self-employment income instead of passive income. That's correct?
Correct. You're essentially meeting the rules of it coming to the level of being a trade or business.
Okay.
Rental income in and of itself is not considered a trade or business. There are some exceptions to that. Like example, for a real estate professional, one of the qualifications is that you spend more than 50% of your time in an activity of a rental trade or business. So, it takes into account, all your other activities. Let's say you're an employee and you work 40 hours a week someplace else. Probably going to be very hard to meet that 50%, of your time requirement. And then, there is a 750 hour requirement too to be a real estate professional. You have to spend 750 hours or more a year in that activity. That's another very difficult hurdle. And that's also per activity. So if you've got one building over here, sometimes if they're totally different activities, you have to consider them separately, even though there is an aggregation where you can combine all these different activities and you add up the hours and try to meet that 750-hour test. That is possible too. So the rules are complex. Most people aren't going to rise to that level unless you're into like land development or some sort of property development, because that is a real estate trader business. A real estate agent could qualify too. So, or people who buy and rehab and then flip properties, that would be a real estate trader business. So if you have all of that, and then and that can be combined maybe with other activities, then you might be able to meet it. But other than that, it's a pretty difficult hurdle to get over.
What if you purchase a property in an LLC, so a business, right, that is primarily set up for buying and selling real estate?
Well, you mean buying and selling like flipping it? Mm-hmm. And then you have a rental on the side?
Yep.
Okay, so those activities would be segregated. You couldn't combine the two to try to turn the passive activity into non-passive.
Okay. See, I'm learning things right now too.
Yeah,
so
me too.
Mm-hmm.
Yeah, you can see how the complexities are they can add up, and you you dig into some really really technical issues when you thought it was I'm just buying real estate and renting it out.
Mm-hmm. Yeah.
Right. Sam, you touched on it a little bit there, but Ryan, this might be a question for an attorney, but I think you probably as a CPA can shed some helpful light on this question as well. But how should a real estate investor structure their investments for optimal tax efficiency?
Well, when you buy property, you can own it in your own name, or you can own it in an LLC, or you can own it in a partnership. There's all these different entities you can own it in. It depends on how many owners there are. If it's just you by yourself, it is probably recommended that you own it in an LLC, just because an LLC at least gives you some sort of limited liability protection in case you get sued. I'm not going to go into all the legal stuff, but if you owned it individually, you kind of open yourself up to your own personal assets being brought into a lawsuit. Mm-hmm. So an LLC does offer some limited legal protection, when that's probably the most recommended route an individual can go through.
Are there different tax implications of an LLC versus a partnership or a corporation or a trust?
So so all the different tax entities, you can be an LLC and be taxed as a partnership if you have multiple owners. So you could be an LLC that's taxed as a partnership, or you can actually be a real partnership, which you kind of see very seldom these days because LLCs offer way better tax advantages. If you own it, if an individual owns it themselves in an LLC, there's really no tax difference. The only thing different there is the legal protection.
So then every time you purchase a property, should you make a separate LLC for that property?
I think that would probably be the better route because you separate them out. You do want to keep all the activities separated, because if you do separate LLCs and you commingle all your funds, then I think legally, an attorney would have to probably bless this, but it's when you commingle all those assets, you open yourself up to all of it being subject to any legal lawsuits or anything against you.
So if your LLC was to own, say, 3 houses, and then something was to happen at one of those properties that you were sued, then they would have, the capability of seizing all 3 of those properties versus that one.
Correct. Mm-hmm. And then from an accounting perspective, you want to keep all of the books and records of each of the properties separated. So you'd want a separate bank account for each. You'd want separate books and records for each, so you can, isolate each activity from each other. Even though maybe at the end of the day, you own all of these LLCs and they all just go on your personal tax return anyway, it all gets reported the same. It'll all be reported on your personal tax return, but you still want to keep everything separate just for that purpose. Mm-hmm.
Is there a software or bookkeeping service that you see people have success with for managing all those different records?
QuickBooks is really good. It's pretty inexpensive and user-friendly, so I would recommend using QuickBooks. If you didn't want to make that investment, then I would say learn to use Excel. Excel can, you can keep track of everything in Excel just fine. But if you really wanted to kind of step up the game, you could use something like QuickBooks, which is just an off-the-shelf software you could buy anywhere. You can even download it online.
Awesome. When it comes to capital gains and losses for real estate transactions, how can an investor or even just a homeowner optimize capital gains taxes when buying and selling real estate?
I think the biggest one is the one we already talked about is doing a 1031 exchange, because that, like I said, that defers the gain until the next property is sold, and then when that property comes up for sale, you can still do another 1031 exchange. So you can kick that can down the road pretty far if you want. But otherwise, if you go to sell and let's say you're not wanting to replace the property, you're just going to sell your building and kind of get out of it, then you just have to report the gain as if you sold the building. It's a building that you sell, so you have to report it as the sale of a business property on a form 4797, and then the building has a basis, which is what you originally bought it for, right? So you would have need to track all of your improvements you've made to that property throughout its lifetime, and then also as you depreciate it, you're reducing the basis by the amount of depreciation expense you take. So that is kind of what your gain at the end of the day is going to be based on. It's going to be based on your original acquisition price, plus any remodels you made, anything you've done to increase the basis, and then minus any depreciation you've taken over the life.
Okay. Awesome. What about a personal property that's a residence? Is there any time that a homeowner should be worried about capital gains in that situation?
So you said personal property. Personal property, you just mean like individually owned.
Individually owned, yep.
Okay, so for
used,
tax
used
purposes,
as a primary residence.
For tax purposes, personal property means something totally different.
Okay. See, I'm learning.
Yeah, personal property means like equipment.
Okay.
It means stuff that's not real estate.
Okay.
But anyway, if it's individually owned, then yes, there are important things to know when you go to sell your residence. Probably the biggest one is going to be the exclusion from capital gains if you meet certain requirements. So if you've lived in your property 2 out of the last 5 years you've owned it, and those 2 years don't need to be consecutive. You can live it in it 1 year, not another, and then another year. At least 2 years of the last 5 years you've owned it, you can exclude up to 250, or let's see, what is it? 250,000 if you're single, 500,000 if you're married, filing joint, of gain, which is a pretty large amount, and that can be excluded from income tax.
And you have to be living in there.
You have to live it. Yeah, you have to live in there. It has to be your residence that you live in there for 2 out of the last 5 years.
Knowing that, it's one of the reasons I point first-time home buyers into properties where, like, hey, you buy a property that you can put some work into, right? Put some time, money into that property, live there for 2 out of 5 years, and then sell it, and you're not subject to tax, right? And that's a huge hit that you're not taking at that point.
Yeah,
right.
Especially in certain market environments where real estate prices are going up pretty much. A small investment into doing remodels yourself, for example, like you said, can pay off a lot. After that 2-year period, and if you want to upgrade to a different house.
Yeah, as far as we talked about record keeping a little bit. Right, but what does record keeping look like? Does it look like saving receipts on everything? As far as say I went and I bought an investment property, right, and I was going to flip it, and we purchased the countertops, we purchased the windows, the foundation need to be fixed. Do we save all those receipts, or do we mark them on our calendar? How do we hang on to that information?
Receipts are important, yes. Accounting kind of basically comes down to tracking inflows and outflows, right? So you're tracking rental income as it's coming in. You're doing some sort of record keeping by recording that in, like, say, QuickBooks, or writing it down in Excel every like doing maybe a monthly, recording of the inflows and outflows. On the outflow side, you're definitely keeping receipts, because if you ever were to be picked for an audit, then in order to substantiate those outflows, you're going to need to produce some sort of records for the IRS. And so receipts are good, bank statements are good, but receipts are better because it actually shows who the money's going to and the amount. So receipts are good to keep.
So how far back can the government audit you?
3 years is a general statute of limitations that they can only go back 3 years. In the case of like severe fraudulent activity or a dollar amount of income that's not been reported, they can go back 7 years. And then any kind of criminal activity, they can go back as long as they want.
So obviously keeping all names out of it, can you tell us a little bit of a story of some time you've seen an audit happen?
Yeah, they happen all the time. It's a good question about how the IRS actually picks returns for examination. They, there's certain line items on tax returns that are probably a little more red flags that could generate like the IRS picking it for an examination. I think that based on those line items, which are probably items that are more of like on the honor system, stuff that doesn't get reported to the IRS, they'll flag that maybe into a different pool, and then from that pool, there might be an automatic, not an automatic, like a random, pick, but that audits happen all the time. They happen for all different types of reasons. There's something called matching notices, which is just a letter you get in the mail that says, hey, we received information from this source that said you got this income, and you didn't report that on your return. So, the IRS, they have these computers that can tell, what was reported to us versus what you reported on your return. And when those things don't match up, you'll get a notice. That's one type of, not really an audit, but it's just a kind of correspondence. Another one is a compliance audit, which they just kind of randomly select returns, and then they'll go through every line on the tax return to make sure those lines, make you give support for what's on those lines. And then other items, like I said, they find certain areas of a tax return that are high risk for fraud, and then they will put that into a pool, and then they can randomly select from that pool who they're going to examine. And there is a really, it's not a high percentage of people getting picked for examinations. It actually is a pretty low number.
Okay, what would you say kind of that number is, roughly?
I have no idea what the actual
different.
percentage is, but it's a pretty low number. The IRS is understaffed and underfunded. They don't have resources to really do full audits right now.
Okay, now, obviously, still stay on top of your, accounting and keeping receipts and being organized with that. But it kind of sounds like it's like picking a straw, right?
Yeah. I mean, like I said, they pick from pools that are high risk, and so if you fill out your tax return, and let's say you have a farm and a Schedule C because you're self-employed, and you have all these different areas that are commonly abused, and they'll have a higher chance of getting picked for an audit.
Yeah.
So speaking of receipts, what about things like Cash App, Venmo? Because nowadays people are just sending money back and forth that way. How can you use that for your taxes?
That's a good question. If you're Venmoing or using Cash App to pay for expenses, you need to probably print out that receipt or save an electronic copy of whatever that is, and make sure that whenever you do that, you actually have the person you send money to. So if it's an individual, you probably need to back that up with yourself documenting what that was spent on. It gets more difficult when it comes to stuff like that, because if an agent were to say, if you spend $10,000 on an air conditioner and for your rental property, and you just paid some individual $10,000 to take care of it,
Yeah.
You just paid. So in other words, the IRS would say, well, you gave me a receipt for this amount paid to Eric. Well, how is that substantiated business deduction? Well, one thing you can do is, if Eric is putting an air conditioner in for you, for example, and he took care of, buying it and installing it for you, you just paid him for his service of doing all that stuff. which included the cost of the air conditioner, you can actually issue him a 1099, which will help substantiate your expense. So you're sending him a 1099, which shows, hey, you've got income, you're going to need a report. And then you actually send a copy to the government too. And so now the IRS has record of, okay, this person should be reporting income, which means you get to take the deduction.
So most people that are listening probably don't have real estate, but they might have stocks, or nowadays a lot of people have cryptocurrency. So what are the tax implications there?
For which one? Either? Because both of those are pretty...
Yeah, they're both really different. I guess let's start with stocks, something people recognize a little bit more.
Okay, stocks are a lot easier than cryptocurrency because stocks are highly regulated. They've been for years. Traditional finance, you go to a brokerage or something, they're going to give you a 1099 at the end of the year, which summarizes all of your activity, your gains and losses, interest, dividend income. Everything is reported on a consolidated 1099, and that is actually reported to the IRS too. So that's a lot easier to deal with.
So
all of that reporting
differ?
is done for you. Cryptocurrency is something totally different because it's not regulated like that. It's still brand new. It's in its infancy, and so if you buy and sell Bitcoin a million times, well, that didn't get reported to the IRS. So it's really up to you to report that correctly.
So I actually had something similar happen to me like that back, in 2020 when everybody was buying and selling crypto. I did the same thing, just a little bit. I dabbled on the side.
How much you lose?
And I actually, that year I didn't lose, but can't say that I'm not losing right now. I'm definitely down, so I'm just holding strong. But
to the moon, right?
Exactly, to the moon. I'm hoping. There's not much I can do at this point. But so what I noticed is when I got my tax return, that for stocks, everything was looked as it should. But then when I got my crypto return from Robinhood, because that's the software that I use to buy it, they used everything on a zero cost basis. So it looked like every time I sold, this is like how much money I was making. I saw it, I freaked out. I was like, what the heck is this? So I really had to do my research, figure out what was going on with that.
Yeah, with crypto, you really need to put in the time to track your own basis. Because if you go and let's say you have Apple stock and you buy Apple stock and then you're like, I'm going to sell it. But you don't just say, I'm going to sell it and I'm going to buy Tesla, okay? You don't exchange Apple stock for Tesla. You actually sell your Apple stock and then you buy Tesla. So you have a buy-sell transaction, right? Well, with crypto, you can exchange. And so those are treated as if they are selling Bitcoin and buying Ethereum, even though that's not exactly how you did it. You kind of just exchanged the two. It is considered as you just sold it and you bought another one. And exchanges don't do a very good job at tracking basis. That really is up to you. It's your own responsibility to track basis. And so I've even noticed on Coinbase, the reports they spit out that's supposed to help you with your taxes aren't exactly accurate and they're not very helpful to use. And so it can get pretty difficult tracking basis, especially if you're dealing with low dollar amounts but high transaction volume. You could be doing this, you could spend hours and hours and hours tracking your sales and your exchanges and your basis and all this stuff, and really you're just dealing with hundreds of dollars. But it could add up to hours and hours of your time just to track your basis. And if you're paying a professional to do that, let's say you traded, you were just trading cryptocurrency $100 at a time, really small amounts, hundreds, thousands of transactions, and in the end you kind of broke even. But now your fee for your professional to do that is probably like $5,000,
Yep.
So really, I think it should be on the individual to track their own cryptocurrency transactions and to keep track of their sales, their basis, all of that stuff.
Oh boy, another reason why I chose real estate. Yep. That stuff always gets above my head.
Yeah.
As far as stock talk goes.
It's new though. Cryptocurrency is new. It's like I said, it's in its infancy. So maybe when it becomes more regulated, it'll be a little bit easier, more like traditional finance, where they track your basis for you and spit you out a nice 1099 at the end of the year that summarizes all your activities, so you don't have to do it. That's probably going to come at some point. We don't know when. It's the SEC and the regulators. They're really bad at this right now because they don't really understand it, and it's hard to incorporate this into traditional finance.
Yeah. Isn't that part of what a lot of people see as the benefit of cryptocurrency, is that it's less highly regulated and less trackable?
Yes. If you were a crypto nerd, you probably would be saying it's decentralized.
Right.
So, yeah, that is an advantage, but even if stuff is not reported to the IRS, it is still you're still responsible for reporting it on your tax return. It's most of the tax system is the honor system, even though a lot of stuff gets reported to the IRS, like W-2s and 1099s. A lot of other stuff doesn't, like business income, for example. That might not get reported to them. So that's like kind of like the honor system. It's the same system here. It is up to the individual to be responsible and to report correctly any amount of income they earn from crypto transactions, even though it's, not really traceable.
So in that same thought, do you think that's why you've been seeing a lot of companies, like the government, really pushing cashless transactions so you can track these things? They really are pushing credit cards on consumers, so they're getting rid of coins. I've noticed in a lot of places. Sometimes people don't accept cash, so it's all credit cards. Do you think that's a good or bad thing, I guess?
I don't really have an opinion on that. I don't think there's any underlying conspiracy to get rid of coins, use of coins and dollars, paper money, for the benefit of any electronic transactions. The government did float the idea of coming out with their own coin, their own U.S. dollar-based cryptocurrency, and there's been a lot of pushback on that. So I don't know. We'll just see what happens as this space evolves.
Tax is
Go ahead.
Tax is complicated. Long story short.
It's getting more and more complicated all the time. More laws change constantly, so it is. It's not really the easiest thing for the average person to do their own taxes these days.
And that's why we always talk at the end of the year.
Yeah.
A couple times, more than a couple times usually.
If you want to do your own taxes, though, there are programs you can use that help you out. Like TurboTax is very user friendly, and if you don't have a lot of activity, you have to have W-2 income and maybe your house itemized deductions. Then that is a very good, useful tool, as opposed to paying for a professional. It's definitely worth a shot at taking that shot and trying to do it yourself. But once you get into more sophisticated stuff like businesses and real property, real estate transactions, then you probably want to consult a professional.
Especially if you're doing multiple properties a year. And trying to keep all that organized and paying the correct amount of tax and trying to keep yourself safe and owning a variety of businesses. Talking to a proper CPA who's super knowledgeable and been in the industry for a long time has only proven to be incredibly valuable to me.
Yeah, not only reporting things correctly, but also, they'll give you tips on how to squeeze every deduction that you actually have out of it. They'll ask you lots of questions of stuff you may have missed. They'll give you ideas on, you drove to your rental property? Well, that mileage is deductible, stuff that you didn't probably know about. And so that's the other area of consulting a tax professional, is that they'll give you insight and they'll try to help you squeeze out every deduction that there is.
I was about to say, every time we talk, I save money, right?
Yeah, that's good.
And that means I'm always coming back.
Yeah, so even though consulting a good CPA might be expensive, in some sense, it's well worth it when you consider the tax savings that you generate from all the new deductions that they would bring to you.
Yeah, you definitely have to be kind of a little more wary about who you consult with, because not every CPA is considered equal. If you go to, some people may offer they just sit there and say, hey, give me your stuff, I'll prepare your tax return. Well, they're not going to be giving you the consulting advice. They're not going to be looking, to try to find every deduction. They're just kind of taking what you give them and putting it on a tax return. And there's a place for those people, but then there's also probably the people whose fees are higher, and they will, sit down with you, go over planning, and consult with everything, maybe even before you even do a transaction. And so they're not just taking your paperwork at the end of the year and putting it on a tax return. They're working with you. They're kind of we like to think of ourselves as advisors too. We're not just sitting here and just preparing tax returns. we try to be a trusted advisor to our clients.
That's awesome. When it comes to selecting a good CPA, what should somebody look for?
Well, references probably, word of mouth. You can ask people, ask your friends who do they use, and that's a great referral source. Is just doing that. If you have an attorney you work with, a lot of times they have the connections to say, well, I like to work with this CPA, or any other professionals you work with. If you work with a financial advisor, they can also give you advice on what CPAs they would recommend. A lot of times, CPAs, financial advisors, attorneys, a lot of times they work in, they do a lot of business development together. And so that would be a good first place to look.
Yeah, I got a variety of different CPAs that I'll recommend to different people depending on their situation. Because I do have people come to me pretty often and say, hey, who do you use as CPA there? Or they just bought their first rental property through me or something of that nature, right? They now own a business that owns a rental property and they want some advice, right? They don't want to just go to TurboTax this year. And pointing a CPA in their direction that's really going to bring them value and keep them safe is super important, right? And so there's some folks that I'll push at Ryan because they own bigger businesses and make more money. And there's some folks that I'll point at buddies of mine who are doing more of the, individual tax rights and then one investment property, right? Not a whole lot. But I have seen the flip side of the coin there, right? And experienced it myself when I was first getting into business of dealing with a CPA who would be like, okay, cool. Oh yeah, you could totally do that. Yeah, that's completely fine. Whatever, right? And they're not held liable for those choices that I'm making in those conversations. If they don't explain it to me properly and I don't have a full grasp on it, that they don't care after they send that off to the IRS, right? It's done, right? So taking somebody who you really trust as well, right, to be your CPA is incredibly important overall, and from my eyes. Would you agree?
Yeah, definitely.
Yeah.
And who you pick can be dependent upon your own situation too. Like if you have one rental property and you're confused maybe on what needs to be done, it's probably not in your best interest to go to one of the big four accounting firms, to go to PwC and say, hey, I need you to do my taxes. And then you get, a $10,000 tax bill or something. Some people, they don't have it in their budget to pay for, those type of firms, because every firm has their own ideal client and what kind of client is in their wheelhouse and the people who they like to work with. And so, you might need to try out a couple people. So asking for a fee quote, get a fee quote before you do anything, to understand what the fee is going to be before any engagement starts.
So Ryan, you explained investing through an LLC. What about, I've seen a lot of investors do it through a trust, like a real estate investment trust. What's the differences in tax implications there?
Well, if you do it through a real estate investment trust, it very well could have to file its own tax return depending on how the trust is set up. There's a whole bunch of different types of trusts, and that's even more complicated than some of this real estate stuff. So I probably won't get into that, but if you can own property through a trust individually, and it's the same thing as almost as owning it through a single member LLC, where you're the only member, it still gets reported on your tax return. I would say that I don't know for sure how much legal protection a trust offers, but usually when you see a REIT, which is a real estate investment trust, it is its own entity that files its own tax return.
What if you're someone who's successful and has, let's say, a lot of properties and wants to set up their inheritance? What do you recommend they should do?
Consult a tax advisor and an attorney. Gotcha. Estate planning is something that your attorney and your CPA kind of need to do together. Your attorney primarily will be working on it because a lot of estate planning involves legal documents, and so you need to understand what do you want, what are your intentions for the future. If you were to pass away, or who do you want the property to go to and how. That stuff is very specific, and those terms are spelled out for in those legal documents, and so that's why you need to work well with an attorney. The CPA will help understand how the tax consequences how those will impact you.
Getting a team of folks.
Definitely.
Estate planning attorney, CPA, and a real estate agent if you need it. But who knows? Who knows? Well, thank you so much, Ryan, for coming on. We learned a bunch. We hope everybody else learned a bunch.
Good to be here.
And excited to talk to you about my taxes coming up here soon.
Yep, we'll need to meet soon. So tax season officially started January 29th is when they opened it up to file. So, yeah.
What's one piece of advice for a listener during this tax season as we end here?
File early is generally what I kind of recommend everybody to do, because identity theft is huge. You know, people, what they'll do is they'll steal your social security number. They'll create fraudulent W-2s, and then they'll file a tax return under your social security number to get a big refund. And once they file under your ID number and you go to file, your return will get rejected. And so if you file before them, it's kind of like first one there wins, you know. If identity theft, you know, it's kind of a pain in the butt. It happens a lot, and it happens more and more in our digital age where people are, you know, doing that kind of stuff, creating fraudulent tax returns. So if you can file as early as possible, it kind of helps prevent some of that fraud happening.
Okay, that's helpful, and another thing that I learned today. So
Stop being lazy. Get on the ball. Consult your CPA and get the ball rolling. That's right.
Yep.
awesome.
Sweet. Well, thank you guys for tuning in, and hope you guys have an awesome rest of your month and are able to jump on the ball and get those taxes taken care of. Sweet.
Right on. Thanks, Ryan.